Charlie, I want to start with you, and it's a special treat to have you on the program because our afternoon program often means that you can't join us because it's so late where you are. You're diving into what's happening with retail traders who have been exposed over the last few years to funds that have traditionally only been given access by, let's say, accredited investors, people with over $1 million in investable assets. But increasingly, you have funds from the likes of Cathie Wood or Robinhood or others that do offer what they say is exposure to private companies. How does that work?
Yeah, it's really interesting, Tim, because basically we're at this moment where we're kind of getting all this fervor and excitement about IPOs. And then we also have this kind of evolution of retail trading, right? We know that's been kind of stacking up over the past, 5 years. We've seen an increase in retail volumes, significant increase in retail volumes from about 15% to about 20%. And then you also have the fact that companies are staying private for longer. So you get this kind of trio of facts coming through, and then some products that are hitting the market or that have really been hitting the market over the past couple of years that sort of give that everyday person who's not accredited, who doesn't have, 6 figures, 7 figures to invest, access to some of these pre-IPO companies, to some of these kind of venture style firms. And there's a real fervor for them right now. And there's a lot of kind of Reddit conversation about this. There's a lot of social media conversation about this, about, everyday people who want to get in, who want to kind of get access. They're talking at the water cooler about SpaceX. They're using Claude. They're using OpenAI. And they feel like the economy around them is changing. They want to get in. And so a lot of these funds, a lot of them are closed-end funds, kind of give them a way to do that.
And Charlie, tell us about kind of what your reporting has uncovered about some of the limitations of these funds. Because, of course, there's no such thing as a free lunch on Wall Street.
What? What do you mean? No, you're totally right. You're totally right. And, there were a lot of teachable moments in some of the investing activities of these people. So I think in the story that I wrote recently, I talked to a father and a son, and they started investing in one of these closed-end funds that gives people access to OpenAI, to SpaceX, to Anthropic. And basically the deal with this fund was that there was a 6-month lockup period, right? So retail investors could get involved. They have to pay much higher fees than, say, to a standard ETF. And they also have to lock up their money for 6 months. And so there was a moment when this fund was just skyrocketing in value. And the 19-year-old son calls up his dad and just goes, okay, wait, I put in 2K. I now have 76K. Am I rich? And the dad has to kind of remind the kid, he was 19, he's not a child. No, like you can't sell yet, right? And this is kind of, a demonstration of that evolution of retail trading to kind of emulate the private markets, to emulate kind of institutional money a lot more than it has in the past. So this is kind of retail starting to learn some of those limitations other investors deal with on an everyday level.
Charlie, there's also fees, and you write a lot about personal finance and investing and the way that fees can eat into future returns. With a product, a closed-end fund such as this, and there are a few that you mentioned here, what do critics say about the fees?
Yeah, I mean, the issue is that they would compound, right? And so there's this sense that, like, if you're paying higher fees and a kind of, standard index fund, that's going to, over time, really compound. And I think that also kind of gets to the point of kind of risk return, right? So I think one of the reasons a lot of retail investors want to get into these funds is because they feel like they've been missing out. They feel like a lot of these kind of VC-style investments have been gate kept. And this is a kind of extension of the democratization of retail trading. But then if you think about it, you're taking on the risk of an earlier stage company, and then you're also having some of the potential returns being eaten into. That kind of brings about questions about how much you're actually getting out of this. And then another risk that a lot of kind of skeptics brought up kind of time and again as I was reporting this was, by the time these stakes are getting to retail, it's pretty late in the cycle of these companies that everyone is so excited about. So there's questions of, have you kind of missed the boat? Yes, this is, you're getting SpaceX. It's not publicly traded yet. That's cool, but it's also a lot later than, say, what a VC would be getting and what they would be kind of, getting the upside from. So I think that kind of has brought a lot of skepticism from people kind of outside the Reddit channels.
Yeah, I'm glad you went there. And that's exactly where I want to bring in Ed Ludlow. He's the co-host of Bloomberg Tech. He's out there in San Francisco. It's just a short drive from Sand Hill Road, where many of those legendary venture capitalists, Ed, are based. And you're looking at this, I know, from the venture capitalist angle. We were just talking about the Series H, was that right? Yeah, Series H round that Anthropic had raised. And the fact that they announced this just days ago, and now they're already on the the path to having an IPO. What do you hear from venture capitalists about retail sort of trying to replicate their success? Because we hear about all the home runs and the grand slams that these VCs and these legendary VCs had, but they'll be the first to say, listen, there are a lot of duds for investments that we've made, and they're not all going to be a winner.
Well, the capital approach of a VC is like across a curve. So you make lots of investments, and over the life cycle of those startups, many of them are net zero. They fail, or they never amount to anything, they never achieve anything. Some of them are acquired very early by a bigger company. Some of them go on to do IPOs, where if you invested in a SpaceX very early, you're getting many X returns your initial investment, especially if you invested early and then again over a series of rounds, either through the primary and secondary markets. The retail investor consideration, in a case like SpaceX, it probably isn't going to move the needle. For one, there's a difference between economic ownership and then voting power. So in this case, pre-IPO, Elon Musk has 85.1% voting control of SpaceX anyway. And those names that are at the top of the cap table after him, Fidelity, Founders Fund, Sequoia, Google, they've been there for a long time. And so they participate in the IPO through the offering, but also you'll see like cornerstone investors come in, like BlackRock, someone like that, who says, okay, I'm muscling into this IPO and I'm going to buy a few $1 billion worth of the offering up front, on IPO day. That squeezes out the retail investor unless there's a very big specific allocation, which, as we talked about before the break, in this case, we just don't know yet.
Charlie, when you talk to the proponents of these funds, when you bring up the lockup period, the higher fees, the risk of investing in a company that's maybe more speculative than a company that's already public, what is their response to those limitations?
Basically what they say is, look, we're democratizing venture capital, right? We're bringing this to more people. Isn't that a good thing? And I think we could spend a lot of time talking about whether or not that's a good thing. But they basically say, look, yes, our funds are higher than if you were investing in like an S&P index fund, but our fees are still cheaper than someone would have to get in a very standard, say, venture capital fund. So they talk about that. They talk about the evolution, right? So some of the people will say, this is early stages. We're in kind of the early innings of the kind of private era of markets, and as people learn more, as more investors, as more retail investors come in, there'll be more transparency. Fees will come down. I think you could really dig into some of those questions. And I think others have said, and this was the head of Robinhood Ventures, who they have a product out that is similar, where you can get exposure to, say, OpenAI, talking about how this could be risky, but it's less risky than, say, starting from day one of a startup. That like we are bringing people much later stage companies, and they're not going to get as much upside, but they're also not going to get as much risk. And so from the people who are kind of bringing these funds to market, you get this realization of, yes, these are different, they're more expensive. They're not going to give you those 10x returns that a VC is going to get, but you still get some exposure. And this is something new. Why don't we try this out?
These are the whales right now, Ed. These are the ones that are getting all the attention. These are the ones that are getting a lot of the oxygen right now. But for venture capitalists who you speak to, where are they putting their money? What's the sort of like, second derivative of a public Anthropic, of a SpaceX, and of an OpenAI?
Well, the thing is that SpaceX in particular, but also Anthropic and OpenAI are like very mature companies now relative to what's happened in the last 12 calendar months. SpaceX was founded in 2002, is that right? And maybe prior to that, and people have been on this journey with them where they've just done a lot in the private market. So applying that thesis elsewhere, there are other companies that are looking at orbital data centers, but there is also an acceptance that you need to have a lot of capital and a lot of scale to make orbital data centers make sense. So like one of those companies is StarCloud, for example. They have an H100 NVIDIA GPU on board a satellite computing in orbit right now, but they're nowhere near the economic might of SpaceX. So like you can apply those. The Frontier Lab thing is getting very interesting because if we bring it back for one moment to the Anthropic confidential filing today, and you compare and contrast, Anthropic is a customer of SpaceX AI's, right? They're renting compute for more than $1 billion a month. In the end, they'll also compete with each other as two frontier model labs that want to sell AI software to enterprise companies. OpenAI is in exactly the same race. And so like somebody at some point is going to have to pick a winner. That doesn't really answer your question, how do venture capitals play the rest of the field? If you're like Sequoia, for example, with SpaceX, you've had to adapt and grow and raise funds and to stay up there, because the bigger phenomenon that's happening now in this game is it's the mutual funds, sovereign wealth funds, and those kind of legacy Wall Street private growth equity names that are coming in and muscling in later rounds.
Okay.
So that's a factor you've got to think about.